I just want to say, thanks for the opportunity. Just building off of the golf business a little bit. Friend, some of you may know, I don't know if he's on the line, Alan Carter. He was he's the reason I have a bad golf swing today, because he taught me the wrong way, and I still can't hit it straight. So anyway, on that note, thanks again. We are in interesting times right now. First and foremost, let's make sure we're healthy and safe. That's first and foremost. But as we move forward, lots of questions, lots of approaches, not a lot of answers, unfortunately. I will say that this call as well is hopefully providing some education for you. I don't know the level of expertise. I'm not sure all the ranges of people on this call as far as skill sets or investment, but I'm going to try and bring it down to level 0, and we can open up at the end of the call for questions and dig down a little bit more. Just a little bit of background on myself and Edward Jones for a second. Been in business for about 30 years, been in multiple different types of businesses, run businesses, media, entertainment, and sports, special events, service business, you name it, I've done it. Moved into the financial services with RBC, and then I moved over to Edward Jones in 2016, and I've been running my office there since in Stouffville. Edward Jones, one of the largest firms in North America. You may or may not know the name. We are owned privately, owned by our partners. We manage about $1.2 trillion in assets, and we have 0 debt. And the reason I tell you that is because in times like this, we're not the company that's sitting there saying we have to cut back, or we're going to fire people. And when I say that as of today. You never know what tomorrow brings, but in 2008, we were one of the only financial services companies that didn't have to lay anyone off. So with that, obviously we're going through some tough times, and we have to figure out our direction. And when Matt and I, connected originally, he saw a post on my LinkedIn page that was titled "A Day in the Life of an Advisor," or myself primarily. And this will summarize in a different way as to an approach that I've been taking for a number of years on explaining investments. And it basically goes through my life as to waking up in the morning, what products I use, whether I use my Apple phone to set my alarm, whether I eat, General Mills cereal, or whether I, have Enbridge gas in my house to heat my hot water. My day goes on, and I use all these different products and services throughout the day. When I take those products and I put it into a presentation in just the truest form, and I simplify it, and I take numbers right back to, say, 2005 and run a 15-year report on something like that, you'd be amazed at the numbers. It's very simple. And it's a very easy way to understand investing. Now, it's not for everybody, but I use that as a starting point, as a launching point as to what and how I try and run my business to make this easy for everybody to understand. So with that, before I just jump into a couple other things, are there any other questions that you have on your mind, burning in your mind, that you just need to get out before I jump into a couple of key areas of portfolios and differences in products per se? Anybody have anything? Matt, anything on the screen there?
Not yet. If anybody, as I mentioned, anybody who does have questions, in the right-hand side is a chat box that you can do that, and I'll moderate it.
Perfect. Okay. So I apologize if I get too granular on you, but I'll try and simplify this as much as I can. There's a lot of noise out there as to buy this, buy that, do this, do that. This product's better than that product, so on and so forth. That's why I told you the story of simplicity of individual stocks. Start with mutual funds. I say this out of all due respect for every other advisor in the business. I do not pounce on anybody. It's a tough enough business, and we all have our approaches and our personal connections, and I respect that. This is not a right or wrong type of dialogue. This is just to show you that there are different ways that some people have not thought of. So when I take a mutual fund and I look at what a mutual fund is, in essence, it's a basket of holdings with a purpose. That basket of holdings can be stocks, bonds, anything in particular that has a purpose and a direction. Generally speaking, and I say general because not all the time, those funds have a minimum of 50, 100, 1,000 number of different companies in them. To build a properly diversified portfolio, we have researched and history has shown you need 25 to 30 stocks, period. Now, in saying that, most of us and the general retail environment have more than that. Do you need more? No, but there comes a point of over-diversified portfolios and duplication and costs. So I take one particular fund and I can do an analysis on this fund that says, and again, the names are irrelevant. Let's take RBC, let's take CIBC, it doesn't really matter. Take one of their dividend funds and take their top holdings. We're not buying swampland in Florida. We're taking the banks. We're taking CP Rail. We're taking Manulife, whatever those top 10 holdings may be. I take those top 10, I move it over to the left-hand side. I run 10-year, 15-year report on the comparison between the fund and those 10 stocks. The 10 stocks win all day long. Now, you may be sitting there saying, well, one is active and one is not. Well, in theory, we provide active management on those stocks to make sure that they're aligned to your portfolio. So what I'm seeing and why I'm bringing this up today is because in business, as you all know, when times are tough, we look at cutting costs, we look at simplifying, we look at doing things differently. Well, and again, I'm not picking on a mutual fund because there are reasons they're out there and they serve a purpose. But in the truest, easiest sense to understand the market and the situation we're in, 90% of my clients have moved to this model because they have comfort in knowing that when I build out a portfolio, I'm buying them an individual company that has certain benefits and we can manage that accordingly. And history has shown when I hold a company individually, that company, as long as it's a dividend paying company, will pay me to hold their shares. In a mutual fund, they still get the dividends. However, the dividends are held and managed differently with the manager. So that manager puts that money into the fund and they send out what's called a distribution. A distribution is not a pure share, it's a number of units. So it's a different equation. The simple fact of the matter is when I take that dividend and I reinvest it and buy more shares of CP Rail, Royal Bank, whatever it may be, over the course of time, good market or bad, that portfolio will grow. And I don't care if you put in risky, non-risky stocks. I've done all the analysis, bank stocks, oil stocks, and just run it out and reinvest the dividends. We win all the time. So that's one comparison with mutual funds, okay? Active management, and again, I apologize if I'm going through this fast. I think my contact information is probably on the screen. If you want to reach out after, discuss further, I can definitely do that for you. On that note, one of the things I am doing for a lot of people, without the numbers in particular, is I get a lot of names of mutual funds that colleagues own, and they don't know what is in them. So I run the report for them to show them these are the companies that you own. Then I do the exact same report, and I show them that in that, that mutual fund that's at RBC, the dividend fund, and the Canadian Growth Fund, and the Global Equity Fund. Guess what? You own TD Bank twice, and you own Microsoft 3 times because there's overlaying in each fund. So we strip all that out. We make it really simple. We own it once. We do the comparison. I show them And then I get to the cost piece, and I explain that the mutual fund has another layer of management, and that's that manager, that fund manager. We strip that piece out. In essence, I own the same companies, the best of the best, and we manage it for a fraction of the cost. So we have active management, they have active management. We have specific ability to buy and sell at leisure. They're selling millions and millions and millions of dollars of shares daily, weekly, monthly, whatever their mandate may be. We can sell a hell of a lot faster than they can. If I have to sell $10 million of Apple, well, I can sell 10, 15 shares of that pretty fast. So there's a lot of difference there. In essence, you own the same companies, and it's cheaper, and performance, like I say, is head and shoulders. And like I say, anybody needs that comparison on what they have, just shoot me a note, send me the names, and I'll gladly run that for you. Active management and passive management. You've probably also heard of ETFs, indexing. There's a lot of different noise, non-biased opinions here, because every product has a place for each individual investor. And as much as I can say 90% of my personal business is derived this way, that's my business. It's not anybody else's. Edward Jones has all these products. None with our particular brand on it. We don't have any proprietary products. I'm not selling you any products. We want to make sure that you have the best portfolio aligned for your needs. That's our primary goal. We have a bunch of tools. It's like having a full bag of golf clubs. We got all the tools there. We can pick and choose as we need them. So active management, ETFs, passive management, and indexing. If your risk is really high and your comfort of volatility is really high, you probably have seen a lot of decline in your portfolios because you're in an index fund and it tracks the index. What that means is you're basically buying the entire stock market and you're tracking it as close as you can minus the fees that index is charging you. So if stock market goes up 20%, you should go up 20% as well. Conversely, it goes down 30, you should go down 30 as well. Keep in mind, when you're down 30 and then try up 30, you're not back to square at this point. For example, in 2018, October through December, market dropped about 22%. If you had got in October and then this past year, when it came up 22%, guess what? You're close to zero again. You came up 22%, but because you were down so much, you're back to close to zero. So it's the comfort in knowing that that's what you're doing. Long term, indexing does win, but indexing is not for everybody. Warren Buffett, some may know him, some may not, has not beat the index in a couple of years, but he owns a lot of specific big name companies. And he's well positioned. He's got billions and billions of dollars sitting in cash for times like today where he's going to come in and he's going to buy individual companies cheap. So there's a bit of a difference. There's a bit of a cost difference on ETFs and indexing as well. And that kind of comes full service to how you build your portfolio, what you have, why your portfolio may be different than your buddies across the street. At the end of the day, it's really what is your goal and what is your plan for getting from A to B, and what is your timeline? And understanding that speaks to the communication piece. Again, not sure who has an advisor, who doesn't have an advisor, but if anybody has an advisor who has an advisor who has not called them just to see how they're doing, I would suggest that the advisor needs to give his head a shake. This is the business. You have to serve your clients, you have to communicate, and you have to be open and honest about that. I called a client this morning, and bad situation with him and his wife, but at the end of the day, we moved his product, his portfolio, that was still up, I might add, into a GIC because he needed a guarantee. Now, am I going to make any money off of that? Selfishly, no, not one nickel. But that's the right thing to do for the client. That's what we do. So with that, I want to pause there and see if there's any questions before I just move on to some of the questions that you've thrown at me to date.
There are a couple. Thoughts on oil financial sector, individual stocks or indexes, bundles of stocks in the same sector?
Okay, so lots of discussion on sectors. This really speaks to the type of individual and the type of investor you are. Okay, we always have a suggested list by sector, and I say it depends on the person because and your timeline, because I could, on one side of the coin, I could say, hey, oil is cheap. If you're investing for 25 years, great, you're buying it at half price. The other side can say, well, the oil sector's been really badly hurt. We're moving to, different forms, and my timeline's short. Stay away from it. That being said, you've heard the term well-diversified portfolio, I'm sure, millions of times. Well-diversified is one thing. Strategically placed and organized is a different thing. So to answer the question, it's first of all, it's individually based. Second of all, it's comfort and timeline. If it's my client, I'm not putting them in oil. I haven't been putting people in oil for probably 2 years. I haven't been putting people in global equities for 2 years. Roll the dice, say it's lucky, say what you will. But I personally believe it's one thing to be globally diversified with opportunities worldwide. I don't like, and my clients don't like the bounciness of that. So we focused on North American large cap with a sliver of growth stocks that we know have a growth story. So energy, if they really want to buy an energy company, pipelines, something with a dividend like a Chevron or something like that, is where I point them. Financials, well, I think financials will be fine. I have no concern about financials. Yeah, they're beat up. Yeah, they're tied to many different things right now and a lot of uncertainty. But this is why I go right back to my story about living the life, and these are the products I use for 15 years, and looking at the history and the performance. That was through 2008 when financials went in the tank, and I've got financials in that plan, TD Bank or Royal Bank, or I can't remember which one I put in there. They'll be fine. And that's the other reason I look at large cap dividend paying stocks, is because on an individual basis, like I said earlier, you get paid for holding a stock outside of a mutual fund. And what that means is on the way down, meaning when the market collapses, and as long as they don't cut their dividend, and banks haven't cut their dividends in 87 years, so knock on wood, I don't anticipate them doing it now, you're still buying on the way down. So where you're buying Royal Bank at $110 last summer, you're buying it at $80 today. In 10 years from now, who knows what you're buying it at, but you're compounding that. You're buying high, you're buying low, and that's not with putting more money in. That's just by taking the dividend that they're paying you to hold the stock. Now, on the flip side of that, if you didn't want to buy more shares, you just take that dividend and put it into cash and do with it what you want, whether it's a retirement account, registered account, tax-free or not. You can do the dividend. You have more control over it. So, hope I've answered the individual stock question. Oil, financials, the index piece is, to me, a generic approach to a long-term investing strategy that you don't want to be specific on. And I may put my kids in an index fund because they don't want to be specific. At times like today, when we have to ask the question, what's going to happen with oil, or anybody is sitting there going, geez, I wish I'd bought Costco stock 6 months ago, or geez, I wish I'd bought, this, or, in the consumer staples sector, which is the boring defensive sector that doesn't go up very often. When those earnings come out, they're going to go through the roof. because of what's happening in society. So you layer the tactical and the practical, and you come up with a theme that builds the story for today, and it will change. So that's why you want to be diversified. You don't want to be over concentrated and exposed. And that kind of speaks to the active management that we do in working with our clients to make sure that, you know, when Apple goes from A to B and we've made $5,000 on that stock, people look at me and say, well, why are we taking the $5,000 and selling it? And I say to them, because you don't know if that Apple is going to go in the tank, and we want to capture the $5,000 so we can go buy that other stock that's on sale, and it's a good quality stock. So it's things like that that we work with our clients on to make sure you have specific reasons and specific targets in specific industries, and we walk through them. Again, selfishly, it's another reason why I try and, you know, move my business towards the individual stock side of it versus the fund side. But again, there are different reasons and different comfort levels with, you know, a stock versus a mutual fund. Any other questions there, Matt?
Yes, there are. Excuse me. In the current market, will a mutual fund outperform a general EFT like Vanguard's VFV?
Not traditionally, no. And it's primarily because of fees. I don't know what exactly, you know, we're referencing which mutual fund against the Vanguard, you know, ETF. But if you say two things are equal, let's just call, you know, a spade, and one costs you $1 and one costs you $2, guess who wins? Simple as that. So if you look at costs and companies within, over diversification, I mean, I can throw another element in there and say, okay, well, I'm gonna pluck these top companies off of there, and I'm gonna put it into my model. And guess who wins? I do. So there's multiple pieces of that. You can't just blanket the statement and say which one wins.
What is a good indicator that the market has hit bottom and is going to start getting back on track? Is there something you can look for specifically?
No. You know what? You can, if somebody tells you they know it's hit the bottom, whether there's so many indicators. Look, I don't mean to be flip, but there's so many indicators. If you're looking to time the market, there's a casino down the street you can go to as well. I was calling clients 2 months ago, you know, excited that certain stocks had dropped 3%. Those same stocks are now down 10 and 12%. Am I an idiot for doing that? No, I'm not. But nobody, and I mean nobody, saw this one coming. And nobody will see the next one coming. Or, you know, who's to say? Maybe they will. But this is where I come back to the value of advice and the value of an advisor working with you. And again, it's a blanket statement, and you can take it for whatever it's worth, but you have to have a relationship. And or not, you can just go online and buy your stocks and do it yourself. But at the end of the day, I've been talking to my clients for the last 2 years, telling them something will happen. Now, I can think of one lady in particular who came to me, and she was 2 years out of retirement, 2 years prior to retirement. And the advisor she was with, and it doesn't matter which company she came from, just the advisor she was with, she wasn't happy, so she came over. I looked at the portfolio, and she was 80% exposed to the stock market and 20% in bonds or whatever on the safety side. And I said to her, I'm not going to be the guy sitting across the desk from you in 2 years from now if something happens to tell you you can't retire. Not my style. And if that's not for you, then I'll show you somewhere else to take your money. But I won't run your money in that manner. Now, if she turned me and said, Drew, don't worry about it. I don't care where it goes. And I have some of those as well. Then that's fine. But it's crucial that I present that to you and I present it in a manner that it protects you. If you disagree, that's fine. But we set it up that way. So conversely, I was on a trip recently. A colleague of mine, when all hell broke loose, said to me, threw him down 30%. I said, I'm sorry to hear that. I knew what he was in. And he said, now I have to work 2 more years. I went, yeah. And that's my worst nightmare, because his advisor did not talk to him and align him properly. And if he did, I will give the advisor credit or the benefit of the doubt. If he did, he didn't recognize or didn't hear him properly, and he didn't make the changes. Because to be down to 30, 31% when he's in mutual funds, that's tough, because it's going to take him a while to climb back up versus getting out, stripping down his costs, and then buying back in, let's call it the same companies again, at a fraction of the price. So there's a lot of that discussion right now. Is my mutual fund portfolio is down X, and I say to client prospect, okay, I know you're down, but business is business again. Cut your losses, and it's not really a loss, but let's take $100 or whatever the value of your portfolio is, move it onto this side. Here are the companies you own. Here's how many we need. So now it's 50 companies. You're paying 2.5%. I'm going to charge you 1.5% or less. Give you the same companies, and guess what? Those companies are going to give you the dividends. They're going to pay you to hold the companies, whether the company's values go down or not, and compound that over time. You come out ahead of the more expensive approach. So it's one approach. It's not for everybody, but that's where I'm seeing a change right now.
Couple other questions here. Can you provide some insights on fees? What are traps and hidden fees to watch out for?
Okay, lots of them. Nothing burns me more than fees. I don't know who's on the line, who I know, who I don't know, but I can't, as my wife says, I'm a bad liar. So when I look you in the face, I have to tell you straight out what I'm charging you. The banks, some may have seen the headline, some may not have seen the headline. TD was just fined $40 million for not disclosing fees for the last 5 years. As Canadians, we rely on our banks, always have. In some ways, I say always will, because I'll buy their stocks because they make money every day. But from a service level and a investment level standpoint, and I say, I blanket this as a general statement from the TD standpoint. Not everybody is the same, but their products are. So there's 2 points here. TD was caught with their pants down. They were charged $4 million, which is nothing for TD. And what that speaks to, in simple terms, is 3 parts. Let's take the $1 and $2 approach again. So if I have a mutual fund that costs me $2 per year to run, out of the $2, I would get $1, and meaning Edward Jones, and the mutual fund company would get $1. That's how it would be broken out. Not exactly 50-50, but for the explanation, that's how it would work. So that's part one. On your statement, what you will see from Edward Jones is fees paid to Edward Jones by a third party, meaning we recognize that we were paid $1 because you bought that mutual fund. Out of that $1, I'm paid a fraction, and the other $1 is not reported because it goes to the mutual fund company. That's a requirement by law that we follow. Well, the banks didn't follow that, TD in particular. And many times I have had arguments and discussions with clients when they put a statement in front of me saying, see, I'm not paying anything. When I take that statement and I actually put it into the legal and show them the legal document that states 2.45%, they look at me and go, what does that mean? Well, that means the operation of that product costs 2.45% to run. That's the legal document. It's called the fund fact document that's required by law to be put in front of a client before you buy it. Well, most people look at that and go, oh, I don't know really what that means. So kind of you glaze over that, and that's it. So that's part of the fee. Is it hidden? Well, if it's not documented and it's not reported, in theory, it's hidden. But the other piece of this is you put into effect an account fee, okay? An account fee means the bank charges you an account to manage your portfolio. So then what happens is there's different series of those mutual funds that some of these banks will put into your portfolio. So just as I use the $2 cost on that same mutual fund, they may say, okay, well, the bank's gonna charge you an account fee of this, and that's it. What they've still done though is they've still put that mutual fund into your account, but they're not getting any money for that mutual fund because it's reduced costs, and that just goes to the mutual fund company. So in essence, they're saying, well, we're only charging this if they're even showing you that. And TD wasn't even showing you that. So most people will come to me, show me their statement, and go, see, I'm not paying anything. But you are. The last piece of this is even worse. When you have a bank, pounding on banks, and look, again, we're neutral in all of this. We deal with banks, we partner with banks, I buy bank products if I need to. But for the sake of the argument and the discussion, a bank will create their own product, their own mutual fund. Call it a balanced fund, call it a growth fund, call it whatever you may. But depending on the series, and this happened to me recently, a client came to me with a balanced portfolio fund. So you walk into the bank and they say, oh yeah, sure, we'll put you in this. It's we call a one ticket solution. It takes care of everything. Don't worry, this is how much maybe it costs you this. Fine. You think, okay, great. I don't really know much about this. Is safe, blah, blah, blah. When you get into the meat of the middle of that product, well, what they've done is they've put in, let's just use RBC, they've put in the RBC Growth Fund, they've put in the RBC Emerging Market Fund, they've put in the RBC Global Fund, they've put in the RBC blah, 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 blah. It's what's called a fund of funds. So the overall sticker price on the surface is, say, $2. But the inner workings of that fund, which are their funds as well, also come with additional costs which are not disclosed. So again, I just saw this recently with a new client that came to me, and they couldn't believe it. Add that, and then go back to my point about stripping out the companies within those funds and the duplication and the costs, and you wonder why mutual funds underperform. That's why. Anything else there, Matt?
Yes. What is your position on shorting the market stock? Is that something you use as part of your strategy?
I don't use shorting. That's not to say I won't. Let's answer it that way. I don't right now. I may use that strategy in future, but it's only because the activity level has been so ridiculous. You also have to look at trading algorithms and institutional trading versus retail trading and movement of companies, and it's a different game. It's a different element. Lots of money can be made that way, but it's a different approach, and it needs a certain type of investor. You got to take care of your primary goal first. If I go down that path, it'll be with somebody that has goal number one taken care of, and this is 1A. Anything else?
That's all right now. Kellen, I see your post. I'm not sure if that's a question or just a comment. So I think in the meantime, we can go back to some of those original questions, Drew.
Okay, sure. So one of the questions that came through was 90-day investment strategy. And this to maximize a portfolio. Well, that's a pretty generic question. I don't know if it's are we maximizing for safety or are we maximizing for opportunity? It really comes back to how we work together, understanding each other. Maximizing opportunity can be a number of things. Managing a risk. One of the discussions, a lot of people have talked about is the airline industry, the cruise industry, and how it's going to be saved or not down the road, and when is a good time to buy in or not. Look, again, you can't time the bottom, just as you can't time the top. I like to play within the goalposts, which is your risk. So if I bought it at Air Canada $25 and it's what 14 or 15 today or whatever, okay, that's fine. But it could have been worth $60 a month ago. You can't look at it that way because you're never going to get it right. And quite frankly, you're going to lose the opportunity at the time. One of the other questions that was asked later, that I was going to get to later, but I'll segue into that right now, is this a good time to buy? Well, it's always a good time to buy. Sure, when we were high, people were asking the same thing. Is it a good time to buy? Yeah. But it speaks to your timeline more than it speaks to what am I paying for the price of the stock, because it's timeline and costs over time, everything works itself out and it grows, and the dividends help compound, et cetera. You can't time this. I can't be more clear on that. There's stats on best days missed of the market, what it costs you in the long term. You really got to start with what is your timeline and manage that accordingly. But just to summarize, you should be in. If I had more money, I'd be putting more in today. And if I'm buying at $50 and tomorrow it's $20, so be it. I bought at 50 versus 100, just as I use the Royal Bank example. I'm thrilled to be buying at $86 or whatever it is today versus 109. So the investment strategy does speak to that on the goals, the purpose, your comfort or risk, volatility, all those types of things. Some would say, should I just buy oil? Yeah, I could say sure, but if you're buying oil, I've given you my thoughts. Buy something that's somewhat safeguarded with a dividend, so it protects you. Enbridge, for example, in a little different sense, if you look at their 5-year number on just their growth is 1.79. If you look at their dividend and their yield, I think you're up at 7 or 8%. So dividend yield is only speaking to your, it factors in price. So when you buy a stock expecting it to grow, if that's what you're buying it for, in the last 5 years, Enbridge hasn't grown that much. The dividend has offset any of the losses that they've incurred, and they haven't grown the overall price because they've used that from the dividend more than anything to offset. So the dividend income has kept their price somewhat stable and grown it a little bit. So you have to understand the mechanics behind why you're buying specific companies, how the growth is factoring in, how the dividend is working. Is the company a good quality company with a good balance sheet? And then put it in that personal, does this make sense? Right back to my story of, hey, I get in the shower every morning, use my Enbridge heat on my, for hot water. And that gives me comfort in knowing that, what, things are probably going to be okay with Enbridge. And then I just get into more details on why. So it brings it to the surface and brings it a little bit more into grasp as in a real world situation. Similar to what we're doing now with WebExes and conference calls and all the social distancing. Well, the world is going to change. There's going to be new opportunities. Just as doors are closing, there'll be new opportunities. And they're vast, they're wide, but we're not at that point yet of saying this is the new one or not, because this downturn was brought on by something that none of us really anticipated, and the fundamentals were strong. Now we're going to go into, we'll see if we actually hit a recession or not, but we're definitely on a downward spiral. I don't see it getting better before it gets worse, but who am I to say? One day it's up, one day it's down. let's get past, take care of the health first, and let's get us back to full force. Let's open the golf courses, let's play some golf, let's get people socializing again, and away we go. Another question I had earlier was capital gains in a corporation. So I'm guessing some of you, the golf pros on the line, may own a corporation, hence the nature of the question. The quick answer on absorbing capital gains in a corp is it depends on how you've invested that money within the corp, how you're capitalizing it. You have to make sure with the new rules that the corporate tax rate, the equation to calculate your capital gains is based on your corporate tax rate. But your corporate tax rate can be affected by the passive income rules that have been changed. So the passive income rules basically state anything over $50,000 in passive income, which includes capital gains capture, I might add, per year will increase your corporate tax rate. So it's not a quick, here's the number, but you have to take it right back to what am I investing in within the corp, because that's where I come back to that mutual fund. It's not it's a good solution for some. A mutual fund in the truest form is a trust. It's managed as a trust, but there's a different series called the corporate class series, and it's basically managed like a corporation. So there's different ways of capturing tax benefits for a corporation within that structure that need to be addressed or not. Just depends on how you set your corp up and what your gains are and what your passive income structure is. Ideally, you don't want to increase your corporate tax structure, but you have to have a plan in place, and you have to answer the question, why are we trying to grab the capital gains at this point? My guess is you want to get the gains off the table, but that's a guess, and I don't know the full situation. Again, anybody who wants to follow up with any questions, you have my contact information there. There's a lot of in-depth stuff and slides and stuff that I can send you, and I'll give you more in-depth conversation and talking points. Accounts to invest in, other than a TFSA, yeah, there's lots. An RSP is to basically lower your taxable income. It's not for everybody. Depends on your situation again. Corporate, if you own your own business, generally an RSP doesn't work for you. You usually put the money back into the business, but not all the time. Depends on what you want to do with the corp. If you want to set up a personal pension plan or individual pension, or what your structure is, but that's on the corporate side. But generally speaking, RSP is to lower your taxable income. That's where most people start. And I say that because if you put money into an RSP, it's not dollar for dollar, but it reduces your taxable income. When you do your taxes, hopefully you get a tax return. And then at that point, I take the tax return money and I put it in a TFSA, because there's limitations on how much you could put into the TFSA every year. And I look at it this way. I'm now utilizing a bucket of an account where I get a tax return, I'm saving from retirement, and I'm filling the TFSA bucket at the same time. So I'm using the money more than once, and I still have liquid money available through the TFSA should I need it. There's also a bigger play on accounts, not on accounts, but it's on estate planning, which we also do, and that's the business insurance, whole life and universal life policies. Depending on your family needs, there's a way to build in equity into insurance policies for estate planning purposes, for savings purposes. But again, those are all on an individual basis, depending on your situation. But we have those available as well, and they're actually very, very popular for estate planning purposes and transferring wealth to generations. Let's see here. Anything else come up there, Matt?
Yes, there's a couple new ones. Excuse me. If there is a government bailout for a specific sector, i.e. airlines, what does it do to the long-term stock price?
Depends on the bailout. That's a hypothetical that I don't think anybody can answer, because you don't know what the bailout's going to be. You don't know what the guidelines around the bailout are. I mean, I know a pilot friend of mine who works for Air Canada who took a pay cut, and I know they're laying off. You know, how long does it take before they jump in? I'll simplify this. I mean, you still have a good viable business, and good viable businesses over time survive. So whether we're talking about 2008 in the financial sector, on an airline like Air Canada, I think it's a no-brainer to say it will kick in. Don't try and time it to say, you know, here's where it's going to start, because you don't know. But that's a specific potential opportunity. And I say potential because you don't know, but they're not going to let the airline go under. But how it affects it is, or the timeline and how long it takes to affect it, nobody really knows. We have a tendency, though, to look for, you know, for opportunities like, you know, I'll throw this one out because it was the topic of, you know, a year or two ago. It's the marketing companies that, you know, throw, well, not this one, but if we look at the marijuana and weed business and what happened there and all the companies, everybody wanted to get in at ground zero and see what would happen. But because good companies weren't established and didn't have strong balance sheets, we didn't know which ones were good and which ones were bad, and we still don't. And they've been going sideways, ways and back. There's so many companies like that where we may think there's a strong balance sheet and there isn't. And you may be surprised, or you may not be surprised to hear companies like Netflix and companies like that don't have strong balance sheets. But there's a time and a place for those types of companies in a portfolio, in partnership with those large cap dividend paying stocks. It's not one or all, it's a bunch. So as it relates to Air Canada, yeah, potential opportunity down the road, but I would still start with what's your core value and what's your core portfolio built around first for long-term excitement and long-term success, because that's what's going to get you there. There's always going to be companies that come and go. Not to say Air Canada is that company, but, you know, companies come out of recessions that turn into massive companies that don't pay dividends, that are growth companies. And sometimes they just go south. Sometimes they continue to grow. But those are opportunities. And there's a lot of those out there as well right now, sector by sector, storyline by storyline. Again, you know, look, I bought Domino's Pizza, and it sounds funny, but I bought Domino's Pizza for clients 6 months ago, and on the fact that they had been one of the strongest balance sheets around for years, but it had a couple of soft quarters, change in own structure, blah blah blah. They hit their earnings out of the park. A client of mine calls me one day and says, "What the hell happened to Domino's today? It's up $100 a share." And I went, "No, come on, you're kidding me." And sure enough, it was up $100 a share. Now, what did we do? We immediately took the $100 per share and put it to our profit, because we knew it was an overreaction to something that was coming, and we captured that gain. So we didn't sell our position in Domino's because it's a good, strong company moving forward, and we still hold it, but we captured that gain. Again, I'm repeating myself, but individually we can manage that opportunity for you versus the manager within the fund where you don't really know what's going on. All you know is it's up or down. But that's, again, individual. Anything else, Matt?
Yes, this is a long one. When you look at a company's balance sheet, what are your serious red flags that you're looking for before investing? Some companies have loads of debt and are essentially losing money on every transaction, but their stock still goes up.
Well, let me just qualify this and say Edward Jones has a 100-year history behind our stock picks, and our analysts do the heavy lifting on that. I put a sliver of my storyline into this, and then I look at free cash flow, earnings, You can look at PE ratios, storylines, growth. Is there a growth story? Royal Bank, for example, has been solid for years, have grown year after year after year. Free cash flow continues to grow. If you have free cash flow, you have options. You can buy back shares, which in theory increases your share value. You can do numerous things, but it's like balancing your checkbook. If you got extra money in the bank, it's a good thing because when times turn south, that extra cash is invaluable. So that's a big one for me. And I'll use the Warren Buffett thing again. You know what? Sure, he may not have beat the index, but look at his cash on the sidelines. I mean, there's rumors around that he's going to go out and buy McDonald's, Starbucks. These are the names they're throwing around, saying he could just digest that and still have $20 billion in his bank account. So free cash flow, PE ratios are important. Or lots of companies are overvalued, but overvalued, you have to watch that. Overvalued with a storyline and some growth, maybe. Beyond Meats is one. It depends on the person again, because you want to jump into an IPO, that's up to you. I will deflect and defer away from it. I'm not a big fan. But it's honestly like going to the casino. This may be a good one, this may be a bad one. Uber didn't do so well. Beyond Meats did it really well, then it tanked. Again, we try and think timing the market is going to be our source of success. 90% of success is asset allocation, not timing the market. Meaning what I was saying earlier on risk. Large cap growth, dividend paying stocks, balance out the buckets of growth, aggressive, middle, and safety. That's the key to success. What's in there? We can debate that.
When two public companies merge, which company would you want to own?
Which one? What companies are we talking about? Just in general?
Yeah, it just says when two public companies merge. Zach, I don't know if you want to expand on that.
Yeah, I'll just say it really depends on many factors. There's too many variables there.
Okay. Any other questions from the group? Just type those in. We've got probably 4 or 5 more minutes that we can spend with Drew here.
Okay. I've got a couple of additional that I didn't get to yet. I'll see if I can get through it. Specific sector discussion. We've talked a little bit about lifestyle and timing. We can be heavy on certain areas. I do like tech. I do like consumer staples. I do like financials where a lot of people don't. Yes, they're beaten up, but I still believe in financials long term. Lifestyle. Again, whether it's Kellogg's, whether it's General Mills, these are boring staples, Procter & Gamble, but they're solid. They've been through this before. Healthcare, Johnson & Johnson. I believe in communications because we're now living in more of a 5G world. Less about the ad revenues that we're generating on Google, but more on how are we connecting ourselves and what's that monthly bill look like consistently. The model in restaurants and all those things are going to change, so I'm not very much of a fan in that sector, in that area. I just wrote down another here, don't speculate. That's just a recipe for disaster. Seen it too many times. Couple of questions on the emergency bailout. I would just direct you to the Canada website, and if you want to send me a note after on that, I can give you a little bit more details, but it's pretty detailed, and my gut says if you're getting a T4 and you're looking for addition and you're making additional and lessons, I don't know how you're recording that or not, if it's cash chances are you may not be eligible, but again, I'm going to direct you to the website on that. I will encourage you, thinking outside the box, to look at, technical operations, technical opportunities on teaching. I have my putter in my office. I definitely need some help with my putting. Video lessons would be helpful for me. Time to invest is now. Don't wait. Get in. But in saying that is, look at your cash flow, make sure you're protected properly. They're all options. I tell everybody, if you can afford a cup of coffee, or depending on your state, put money in and forget about it. Take it out automatically, let it go, and in 10 years you'd be amazed at how much you do have. On that one example that I was telling you about earlier, I put $25,000. I didn't personally, but if I had put $25,000 in 2005, 30 stocks today would be worth $300,000. And that's with not putting another nickel in. That's just with compounding. And I might add, it's only with companies that are pretty straight ahead companies. The only two that would be pretty substantial growth in there. And again, 25,000 was the initial put and not any additional. And these don't pay dividends. With Amazon, they've had obviously huge growth over the years. Apple does pay a dividend, and then Google. So those would be the ones that have driven the majority, but you still saw growth out of all the others, banks, et cetera, through the 2008 crash as well. So I think I've gone through most of the questions that you've asked. Again, I apologize if I've lost you along the way on some of the technical stuff. I will summarize by saying it is about the relationship and understanding each other. That speaks to products, that speaks to risk, that speaks to today and tomorrow. Whatever the circumstances are, we are Switzerland. We don't have a bias on anything, as much as I may have led you down a path of my own personal opinion. We have everything available with ETFs, mutual funds, annuities, whatever it may be, is the right solution for you today. That's the major difference that a full brokerage like Edward Jones will provide versus your local bank, and to a lesser extent, the wealth divisions at some of the banks that, that's a little, you have to be at a different level to get into there. Then you fight for your position and your relationship. So I want to leave it at that. Encourage you to reach out. If you want information on mutual funds that you have, don't need numbers, just shoot me a name. Give me a call. I'm open to any of this. I'm here to help. Again, I'm not a big believer in people taking advantage of anybody on fees. And if we can simplify our businesses, as you all know, that will get us through. Hopefully it will get us through. Mother Nature obviously will help us along the way as well. Simplify, cut our costs, look at the big picture, take it day by day. I'll leave it at that.
Thanks so much, Drew. I just input his contact information back on the screen if you wanted to reach out to him directly. On behalf of everyone on this and our entire membership, Drew, thanks for taking the hour. And to those who are watching, keep in touch with our resource hub. Lots there, new resources getting posted every day. And if there's anything that we, the PGA of Canada, can do for you, we're all ears, and you should have my email. So thanks everyone for tuning in.
Thank you.